Welcome to Talk Tickers.
Your shortcut to understanding crucial earnings call.
Exactly. You're busy, but you need to stay informed on what's moving the markets. That's where we come in. Today, we're diving deep into Great Southern Bancorp's Q1 2025 earnings call.
Yeah, a lot to unpack there.
So let's get right into it. What's the big picture from this call?
Well, in a nutshell, Great Southern Bancorp, they reported a pretty strong first quarter.
Strong how?
Net income saw a significant jump, came in at $17.2 million. That's 1.47 per share.
Okay, and how does that compare?
That's up quite a bit from the same time last year. Last year it was $13.4 million, or 1.13 per share.
Wow, okay. So what drove that improvement?
Mainly two things. Higher net interest income, basically making more money on their core lending, and interestingly, a negative provision for credit losses.
Negative provision. So they actually released reserves.
That's right. We'll get into that. But yeah, it suggests confidence in their loan book.
Okay, let's start with that net interest income then. You said it was up.
Yeah, healthy increase. It hit $49.3 million, up from about $44.8 million year over year.
And the margin, the net interest margin.
That improved too. Climbed to 3.57%, up from 3.32%. So better profitability on their assets versus their funding costs.
So fundamentally, they're making more on, their bread and butter, lending money and managing it.
Precisely. Better yields on loans and investments. And they seem to have managed their funding costs effectively. There was actually a little temporary boost to the margin too, about 5 basis points from some interest recoveries back in March.
And they pulled this off even with deposit costs being such a focus everywhere. That pressure we keep hearing about.
Seems so. Careful balance sheet management was the phrase used. But there's a heads up for the future.
Oh. What's that?
They flagged that an interest rate swap is ending. It means about $2 million per quarter in interest income will likely disappear after Q3 this year.
Okay, so like an agreement they had is just running out.
Yeah, essentially. It provided a benefit, and now that benefit's scheduled to stop. Something to watch in Q4 and beyond.
Definitely noted. Okay, what about the loans themselves, the actual portfolio? Did it grow?
Not really. It was essentially flat, holding steady around $4.76 billion.
And what makes up that portfolio? Any big concentrations?
The main segments are multifamily properties, the apartment buildings, that's about $1.6 billion.
Okay.
And commercial real estate, offices, retail, that kind of thing, around $1.5 billion. They also mentioned construction lending, about $475 million, with a decent pipeline of unfunded commitments. So projects ready to draw down funds.
Sounds stable, but flat isn't exactly growth. What did management say about the lending environment generally?
Yeah, they pointed that out, said it's characterized by tepid growth overall.
All tepid.
And significant competition. Banks are really fighting for the loans that are out there. So expanding the portfolio significantly looks, challenging right now.
Right, makes sense. Let's flip to the other side of the balance sheet deposits. How did they do attracting funds?
Saw some positive movement there. Deposits actually increased by 3.3% just since the end of last year, reached $4.76 billion, basically matching the loan size.
Where did that growth come from?
A mix. Some from brokered deposits, those larger deposits often placed via intermediaries, but also growth in core checking balances.
Interesting. Did they see that shift from non-interest-bearing to interest-bearing accounts that everyone's been talking about?
Yes, they did see some of that shift. But the key takeaway seems to be they managed their total deposit costs effectively, despite that.
Okay. And the quality of the loans. You mentioned that negative provision earlier, which sounds good, but any other signs?
Yeah, credit quality looks very solid based on their report.
Like what metrics?
Non-performing assets loans seriously behind on payments were minimal. Pretty consistent with recent quarters.
Good.
And net charge-offs, the loans they actually wrote off, negligible in Q1, barely registered.
So that negative provision really reflects that underlying strength then?
Exactly. It signals they felt comfortable releasing some reserves previously set aside for potential losses. Their overall allowance for credit losses stood at 1.36% of total loans. Still a solid cushion.
Good to hear. What about their own costs? Running the bank, paying staff, keeping the lights on? Non-interest expenses?
Also pretty stable. It's essentially flat compared to last year, around $34.8 million.
Flat even with inflation and investments.
Yeah, which is notable because they did mention investing in tech, infrastructure, and people.
So how they manage that?
Well, one factor was lower legal and professional fees this year compared to last year, when they had higher costs tied to a big core system conversion.
Oh, okay.
Salaries and benefits were up a bit, standard merit increases. Occupancy and equipment costs also ticked up slightly, partly systems investments, but also, get this, higher snow removal costs.
Really shows you the details that matter, doesn't it?
It does, but overall it points towards efficiency. Their efficiency ratio improved quite a bit.
Right, lower is better there.
Yeah, dropped to 62.27% from 66.68% a year ago. So costing them less to make each dollar of revenue.
But wasn't there a one-off item helping there?
Good catch.
Yeah.
Yes, there was. A one-time benefit, around $400,000, tied to debit card activity. Helped offset marketing costs in Q1, but they explicitly said that won't repeat in Q2.
Okay, something else to factor in going forward. Let's talk overall financial health. Capital position. Buffers.
Looks robust. Total shareholder equity increased to $613 million. Total capital also got a boost, partly because the market value of some of their investments and those interest rate swaps improved.
And regulatory requirements.
They're operating well above all the required regulatory capital levels. Comfortable cushion there.
And they announced something on share buybacks too, right?
And they did. A new authorization for up to 1 million shares. That's on top of about 270,000 shares still remaining under the old program. So quite a bit of firepower there if they choose to use it.
Interesting. More buybacks, flat loan growth.
Yeah.
What was management's overall tone or outlook?
They definitely emphasized the strength of the core bank, the resilience of earnings despite, economic headwinds.
Standard message, maybe?
Sort of, but they backed it up. Focus remains on execution, protecting that margin we talked about, managing credit proactively, trying to grow loans through relationships, and making those strategic investments.
Did they sound worried about the economy?
They acknowledge the uncertainty, economic and market uncertainty, but they stress that their balance sheet and capital levels are strong, positioning them well.
Okay. And the big question everyone asks banks now, Fed rate cuts, what's their take?
Yeah, they address that. They expect maybe a slight negative hit initially if the Fed cuts rates.
But only initially.
That's what they indicated. They think they can adjust fairly quickly. They describe their overall interest rate risk position as pretty neutral.
Neutral? How so?
They pointed out that a couple $2 billion in loans are tied to variable rates like prime or SOFR, so those would reprice down fairly fast. But similarly, a couple billion in interest-bearing checking deposits would also likely see their rates adjusted downwards too, offsetting some of that pressure.
So levers on both sides to pull. Makes sense.
Sure.
Okay, let's try and synthesize this. What are the key takeaways for someone tracking this bank or the sector?
Well, first, that jump in net income and margin is definitely positive. Suggests good underlying profitability, at least for now. But yeah, the flat loan growth combined with that big new share buyback plan, it could suggest management maybe sees fewer slam dunk organic growth options right now. Buybacks look like a good use of capital in that view.
Right. What else?
That interest rate swap ending in Q3, that's a definite headwind for net interest income starting in Q4. Need to factor that $2 million quarterly drop in.
Got it.
Their view on interest rate risk being neutral suggests they feel reasonably well positioned whether rates go down or stay put for longer.
And the competition point.
Yeah, that comment about tough competition and slow loan growth isn't unique to them. It's a wider theme in banking right now, worth remembering.
Absolutely. Okay, time for our favorite segment. This is not financial advice. Purely speculative, maybe even a little outrageous. What's a potential trade idea someone might cook up after hearing this call?
All right, disclaimer firmly in place, right? Not advice.
Absolutely not advice, just spitballing.
Okay, idea one. You look at the flat loan growth, but you also see this hefty new share buyback authorization. So one angle could be a shorter term play, speculating that the buybacks themselves, reducing the number of shares out there, could provide some support or even a little lift to the stock price, especially if the overall market holds up.
So less about fundamentals, more about share supply shrinking.
Kind of. It's a bet on the buyback impact in the near term. And it's a big bet. You have to keep that expiring interest rate swap in mind. That's coming later this year and could definitely weigh on future earnings expectations. So it's tactical, potentially higher risk.
Got it. Any other wild ideas?
Maybe a contrarian one. Focus on the deposit side. They grew deposits, managed costs.
Right.
So maybe you bet against the idea that rate cuts automatically crush their margins. A contrarian play might involve betting they could manage deposit repricing effectively. Maybe lowering deposit costs faster than loan yields fall if rates do get cut.
That sounds tricky.
Oh, highly speculative. It really depends on how they manage those deposit rates versus loan rates and the timing and size of any Fed moves. It's a bet on their specific management skill in a changing rate environment. Definitely not for the faint of heart.
Definitely not. Okay, that wraps up our deep dive into Great Southern Bancorp's Q1 2025 earnings. We've unpacked the numbers, looked at the outlook, even tossed around some highly speculative ideas.
And remember, folks, none of this was financial advice. Please do your own homework, your own research before making any investment decisions.
Absolutely. What stood out to you from this call? Still got questions? Let us know. We always want to hear what you're thinking about.
Yeah, helps us figure out what to dive into next.
Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.